Okay, so this is my recent S&P 500 or VIX trade. Now, this is the S&P 500. It is the 1/10, the smaller version. So it is $450 a share currently. The actual S&P 500 is 4,502 roughly. So a fraction of. This is the VIX, and it is the volatility index. It is also relates to the pricing of options. So when this is down low on the chart, then option prices are bought and sold for a cheap price. As this spikes up, option prices in general become more expensive to buy and sell. Now, what happens is every red line here is the third week of every month, the options expiration. So it is the third Friday of every month. And as you can see, towards every Friday, every expiration Friday, it spikes up. It is very normal. It doesn't, this was only a little one, this one was only a little, but it typically always spikes up. Sometimes only a little bit, sometimes a lot. You don't really know. So, as it was coming down here, and this is the 13th of August, you can see down here at the bottom, 13th of August, that was a Friday. As the week was developing and volatility was dropping, rolling off, I knew we were closing into the last week of the options before they expire. Now at the same time on the S&P and on the Russell and the NASDAQ, so they've all been grinding higher and higher and higher. They're entering, this is the Friday the 13th, as you can see it was at all-time highs. So at this point, with this pretty much at all-time lows, or not all-time lows, but current lows, with this at all-time highs, what happens is as this spikes up, the S&P or the index, NASDAQ, Russell, Dow Jones, all those, they typically roll over. As you can see, every month that the VIX spiked, the S&P 500 typically dropped. Once again, it might only drop a little bit, it might drop a lot. You just don't really know. But as you can see, it typically always drops. So, as part of this drop, so as it's coming up to all these highs, I thought, all right, let's go it. So option prices are going to get dearer. So if I buy puts, which is this, I'll show you my trade, and I'll go to from a daily to a 1 hour time frame. So you can now see each of these vertical lines is the end of day. So leading up to the close of Thursday, here's Friday's trading, and then the end of the month is 1, 2, 3, 4, 5 days away. So actually this is Friday morning, that's when I entered. So I bought 4 puts at the money, basically. So there's 446. So they were just in the money, which means they were just higher than the share price. I bought 4 of those at 427, so $1,700. I also bought 2 at 447 for 438 or 876. 447 is just a little bit more in the money, so it's a little bit more expensive. A bit more hopefully guaranteed to hold price. Now that day nothing much happened. It tried to rally a little bit into the close, which is sort of here. It's come off the lows and rallied a bit. If I go to 1 hour, find, where's the 13th? It's probably here somewhere. 17th, 16th, 13th, it's here. So as it's coming down, it's getting cheaper and cheaper. And this is when I bought in. I bought in on this morning here at opening. Now, at the end of the day, the prices were still relatively the same, but then the next day it's opened up higher. So option prices are dearer, and then it's faded away. It's opened up higher, which has dropped this, and then as the VIX faded away, this rallied. It does the opposite, the adverse reaction. So at this point I was possibly negative, maybe a few dollars. I think it was like 20 or 40, maybe even 80, I can't remember. It wasn't much, that's for sure. I'm still confident that I'm going to get a drop into the options expiration. So I held them, then it started spiking, and then on the Wednesday, it really spiked up at close, which really crashed it down. You can see Wednesday, it really brought the markets down here. But as it was coming down here, I was up in profit. It looked like it possibly could hold. I was a bit nervous. I didn't know if it would hold or not, because you never know how much of a move you're going to actually get. So I basically chickened out and took the money and ran. So what happened to my trade? My 446 puts that I bought for 17 cost me $1,700. I sold them for nearly $3,000 or a $1,200 profit. And keep in mind that I sold it only from this level down to this level. It actually dropped twice as much. The two puts that I bought for 438 or 876, I sold for $8 or $1,600. So basically I made nearly 100% profit or return on my money. All in all, I made nearly $2,000 profit, so $1,200 and $700, just on that little move, just on closing out options expirations down low. And then the other reaction to that is this is the Friday options expiration. Once options expiration happens, typically after that little spike in the VIX, if I go back to a daily, once it's done that spike, it then crashes and rolls off. Does the spike, then crashes and rolls off. Does the spike, it does it every single month nearly. So as that then rolls off for the next month, the markets recover and they then start going up. So at that point, I bought just a couple of small calls, one for $700, one for $600, and I bought a butterfly. The butterfly is a 435, 445, 455. So it is a, if I plot this, 435, 455. So basically between these 2 points, hopefully right in the middle, 445. So 435, 455, in the middle is 445. I was expecting that the stock of S&P 500 SPY would then return to 445. If it returned to 445, that is the optimum profit for my trade expiring September 3rd. Unfortunately, it popped a little high, and here was looking not too bad at 446, even as high as 448. At 450, I am basically break even, so I'm not actually sure if I'm going to make profit on this trade or not. It might be a loser. I might have to close out for a $20, $50 loss. I will see. It expires this Friday, so I will see how it goes over the next couple of days. But So basically at $450 on the S&P 500, that is my butterfly break even. It will have time decay sort of helping it a little bit if it goes below, but I think absolute max at 451 there is no more profit in it. So by Friday it needs to be definitely below 451 to make any profit. If it goes below that down to this line, obviously the 435, then yes, I'll be making profit. 445, like I said, is the maximum area for profit. The more that it can be closer to that by Friday will be the more potential profit, but it's not a big trade. I'm maybe looking at making $100 or $2 or $200 if at all, if I'm lucky to even make that. Yeah. So anyway, we'll see what happens. But yeah, my main trade for this is the spy calls. Although they will get hurt if it comes to 445, I am kind of hoping that it does continue and goes to 452, which I've got my exit set at here for $14 and $12. So if I can get out for that, that is almost 100% profit on both of those. So that will be about a 1200. What was that second figure? So $12. So yeah, 6 and so it'll be about a 13 or 14, just under 14, but about a $1,300 profit. If it can spike up to this, but I do have 2 weeks, so you know, if I go out 2 weeks in time to the 13th, which is here, you know, it could continue to rise and it could come up higher, but I'm expecting it'll hit resistance at this line at the 452. So if it hits that, obviously I will take profit. I've already got my exit orders set on that. So but yeah, that is my S&P 500 trade, monthly trade, my VIX trade, if you want to call it that. It is yeah, something that can be done each month. It might be something that I start doing on a bigger scale to make a little bit more money. I mean, if I can make, so I made $2,000 on the down. If I can make another $1,200 to the upside, that's, you know, $3,000. If I can do double the position size, maybe I can make 5,000 or more next month. You know, on a simple 1 or 2 week trade. So it'll be something that I look at depending on how much spare equity I have. Possibly look at doing more position size and trying to make a little bit more money on that monthly event. But anyway, that is my logic and reasoning behind the current S&P 500 positions that I have on. Cool. That's it. Simple.